Hey traders, this is Jeff from ZenTrader.ca with an update. I want to spend the majority of this update on the VIX. In this chart, it's a daily chart. It goes back to 2005, but I've actually removed the actual VIX indicator, and all that's left is the 10-day moving average. So my goal here is to take a little bit of volatility out of the volatility index so you can kind of see a smoother picture. And I've deemed these four levels: extreme volatility, high, normal, and low volatility, as periods, reflections of volatility in the market. You can see basically for a good bit of last year we were in a state of high volatility, and in John Bollinger's book Bollinger on Bollinger Bands, he really stresses the concept of periods of high volatility lead to low volatility. So here's the high volatility coming back down, and right now I would say we're at normal. I wouldn't say that we're at extreme low areas of volatility. I think we're just right around normal, but periods of low volatility lead to high volatility. So I think we're going to get a little bit of a period of increased volatility here, given that we've come all this way. We've really sucked a lot of that volatility out of the market. And what I want to do with this video is to show you the times in the past where the market had come from an area of high or above back down to normal, and then what happened. So let's look at this first example. Is here we were at high areas, and then we come back down, and that was a pretty decent market top. It rallied. It sold off down, then it rallied up more, and then it really fell quite a bit. So the point being is taking on new positions around here would have been very risky. This next area here, we were up here again, in an area of high volatility. We sold back down to normal, and that was pretty good for a market top. We sold down, rallied back up, made a double top, and then proceeded to sell off, and then that was the '08 meltdown essentially. Okay, so the next period in time was right at 2010. We were obviously in a period of, I should label this, insane volatility, and we came back down to normal, and that was a market top, and that was a short-term market top, but a market top that would have been a dangerous area to be buying stocks in on that day, or even on that week. Sold down, and then it rallied again. And then the reason why I have this area in a square here is because it didn't get out of this area of normal. So I'm not including this in this particular study, because you really want the volatility to be increased and then sell back off to normal. I hope that makes sense. I would say that would not have been a good trade. And this brings us to this period where we were at extreme, and it sold off. And this was the one case, okay, out of four. So 1 in 4, one in the last 4 times that this would not have been a good trade, because it went into low volatility, but the market just kept climbing higher. And while eventually it did sell off, I don't think that would not have been a good trade at all. So a 1 in 4. So my point in all of this is now we're back here where we're at an area where we were in really high volatility, and we've come down. So 3 of the last 4 times this has been good for a market top. So that's just something to consider if you're not in the market and you're looking to be putting some money in. Consider that. If you're in the market and you've been in the market and you've been profiting, now is a really good time to start taking some money off the table. There'll be opportunities to buy the dips, I think. So traders, take care. Talk to you later.